Back on Morning Line, thanks for joining us. Ralph Perry's with us, Tennessee Housing and Development Agency, talking about, among other things, you know, the lower interest loans that are available for first-time home buyers and others. If you're looking to buy a place in a market that's just booming, you know, this is a hot place to live. Everyone wants to come here. And, you know, I was asking him during the break about what went on with, you know, his agency during, 2008, 2009, when the market really crashed a lot because of these horrible loans where the banks were giving people more money who had bad credit for more house than they needed. Now, you've never done it that way. No. In fact, if we did it your way all along, we wouldn't have had that problem back then.
I certainly think so. You know, we've always done careful, conservative underwriting. We try to offer a fair price to a first-time home buyer, but you know, you're not doing anyone any favor putting them in a mortgage situation that won't work. It wasn't so much the banks. A lot of times what happened 10 years ago was you had a situation where you and I, with a warehouse line of credit, could go in the mortgage origination business as a broker. And we make somebody a loan, and then we sell it to somebody on Wall Street who's going to sell it to Sven in Denmark, who thinks he's getting AAA paper. We make a generous fee on the front end. We get our lending capital back, and we just keep doing that. And if that loan goes sideways, you know, it's not the broker's problem. All that has pretty well run itself out of the system. You know, we have standards. You know, this is what the loan has to look like. If you don't have this credit score, if you're not income qualified, you know, if other things don't match up like they need to, then, you know, frequently we've told people the best thing you can do is work with our counseling partners till we, you know, wait 8 months until your credit score is higher, you've got a little more money in the bank.
So what you're saying is that there is a threshold. You talk about many of your customers are those with credit scores in the 600s or so. If someone's coming in with a 500 score, you're gonna, and if you have a 500, it's probably because you've had issues paying. Either, you know, for a lot of reasons that can happen. You're not going to, you don't want to.
The credit score is often the leading determinant for whether that's going to be a good loan going forward. Because, I mean, income, there are people who are high earners who have lousy credit scores. What the credit score tells you is, do you have a willingness and a habit of paying your bills? And someone who is not in that habit, you know, we get a little nervous. FHA will put a taxpayer guarantee behind a mortgage made to somebody with a credit score in the high 500s. At THDA, we want to see a 640.
I was going to say, and the difference is because you believe 640, they've shown. Now, if someone comes to you and they're in the 500s, then your idea would be, look, you don't qualify now, but show me. And what, you know, maybe
you know, we have a terrific network of home buyer education counseling partners. And generally what our lenders are going to do is, well, you don't qualify for this now, but why don't you work with this counselor? And the counselors often can say, look, let's work together. Let's get you on a plan. Let's help you understand budgeting. And in 8 months, if you do these things, your debt will be lower, your credit score will be higher, you'll be in better shape to qualify for the mortgage and to succeed in home ownership, which is what we want. You know, at the height of all the subprime crisis, when almost 1 out of 3 subprime loans was delinquent, THDA's delinquency rates were 1/3 of that.
And it's for the very reason.
And our book continues to perform. You know, our delinquency rates are comparable to the overall FHA book of business, and when you consider that we deal with a customer who's got a slightly lower credit score, slightly lower income, needs down payment assistance, and the book performs well, you know, that's not by accident. It's a result of the underwriting that we do, the counseling that we require.
So what I'm getting from you is that you don't have too many folks defaulting on their loans and walking away from these mortgages.
No. You know, typically when a THDA loan goes really sideways, it's for traditional reasons. Someone has lost their job,
illness,
divorce, serious illness, those kinds of things. But you just don't. We do not typically see someone who has overextended themselves because we don't underwrite that way.
When you look at the state as a whole, can you give me a sense of what you guys are seeing, maybe based on you know, what you're hearing from the folks coming to you for these loans? I mean, would you say right now the hottest area is in the mid-state region?
It has been for some time. Nashville and the 8 counties around it, those are among the fastest growing places in the state.
People coming from all over the country here, or others from elsewhere in the state? Kim, I don't know if you have any breakdown of that.
The state's demographics, West Tennessee has been losing population for about 20 years. East Tennessee is holding its own. Nashville and Middle Tennessee are where the growth areas are, and that's represented an awful lot of our business over the last few years. In some years, more than half of our mortgage business, actually. We have really worked our outreach and marketing at either end of the state. A couple of years ago, before we started that, East Tennessee, for example, was only 23% of our business. Now it's generally over 30%. Even in Shelby County, which for a variety of reasons is a difficult place. You have more people who have gone through foreclosures and bankruptcies, and you have a lot more income challenged folks down there. But we're probably going to close 40% more loans in Shelby County this year than we did last. My belief, and as I've traveled around the state, my first year, having served on the board, I just figured, well, everybody knows what Tennessee Housing is and what we do. And it didn't take me long to meet people and going, THDA, huh? That's great. What do y'all do?
Well, I thought,
my guess is we don't have to dumb down our underwriting. We don't have to broaden our eligibility criteria. We have a good product, a great product that is a great choice for a lot of people right now. And what we want them to do is be aware of that. So if you're thinking that, well, everything I've read, it's hard to get a mortgage, I'm not even going to think about it. What we encourage people to do is take a minute and go to greatchoicetn.com, click on that first-time homebuyer link, and what you'll find there is a really good rate on a 30-year fixed-rate, no-gimmick mortgage with some down payment assistance if you need it, and links to counselors and lenders who can get you started.
And again, you buy and take on the loans from the banks. So what other monies are involved with this, like the down payments and the like? Where is this coming from? The funding for your department? Bond financing.
The state authorizes us to sell bonds. And we use the proceeds from those bond sales to buy the mortgages that are originated on our terms. The down payment money comes from the same source. It's actually a forgivable second. We will provide up to 4% of the purchase price. If you stay in that home, there's zero interest on that extra money. You make no payments on it for 10 years, and if you're still in your home, we'll forgive the balance 20% a year for the next 5 years.
You could end up, if you stay long enough, get to the point where you don't even have to pay back that,
And if somebody moves earlier than 10 years, we get our down payment assistance back at their sale, and that we put back in the pool, and it's there for the next person that needs it.
I'm guessing if the state's invested in this, and the reason for it is that it's good for the economy as a whole. And I guess from the outside looking, it should be pretty obvious that buying and selling properties, home sales generates and spurs the economy on. Is that the primary?
Well, absolutely. I mean, look, if the economic downturn proved anything, it's that housing's a big part of the economy. The economy gets going when housing gets going. And historically, housing gets going when first-time buyers start to get back into the market. And that's where we come in, getting those first-time buyers into the market with a product that makes financial sense to them.
Okay, so did you get the sense, one reason this push is out there, that a lot of these potential first-time buyers, for whatever reason, maybe cost, supply, demand, were opting more for rentals? I mean, that's what you heard. I mean, it's hard to find good apartments now. And I'm wondering sometimes, when I see how much someone pays for an apartment, that's almost the same as it would be for a mortgage. And unless you're just a short-timer, you're leaving in a year, I understand. Why not build some equity and buy something?
I think you had a couple of things going on. If you feel less secure in your employment, you're going to wait a while before making that kind of a commitment. For reasons that have been much discussed, a lot of young people are waiting a little longer to form households, to think about having children, to think about buying a home. But eventually, they're going to want to do those things. And our sense was there was so much negativity out there about, oh, it's hard to get a mortgage. Don't even try, or you don't want to do that. So we wanted people to know that if homeownership is right for you right now, we have a product that will help you get there that makes financial sense for you. I think some folks are still just going to want to rent for a while until they say, well, I like Nashville. Where in Nashville do I want to live? Or, you know, if you have the kind of job where, you know, you may have a neat opportunity to move somewhere else, you don't want the hassle of having to sell a house where you go. The other thing I think is people are approaching home ownership a little bit differently. 10 years ago, what you're hearing is, well, just buy something because next year it'll be worth more money, and if you move, you could sell, you make money. Now, that's not necessarily true in every market.
Right.
And what I think people are thinking about is the place I buy is the place I want to live, the place I want to make my home.
Right.
And they're being a little bit more deliberate about that choice.
Yeah, because it used to be, and I don't know if you hear this as much, it's been a while since I bought a home, but that they say buy something a little more than you can afford. Maybe a little bit bigger, which always left me scratching my head saying, gosh, why? But then the thinking was, no matter what, in every case, your home is going to go up in value. As we've seen, that doesn't always happen. Most of the time, I think a home is a good investment.
Yeah. Generally it is, but you know, when you think about buy a little more home than you need, well, some people took that to ridiculous extremes.
Right.
And they bought way more house than they needed or could afford, didn't have furniture in half the rooms. You know, an awful lot of the people who cratered in the financial collapse, those were not low-income people getting a starter home. Those were people who were getting conventional, what were called conventional conforming loans, and instead of buying a $300,000 house, they stretched to get a $600,000 house, and then woke up one day to find it was really a $400,000 house, and their interest in paying that note went way down at that point.
Went way beyond their means.
Yeah, I mean it's never a good idea to overextend yourself.
No, exactly,
you know, and that's you know one of the requirements on our loan is, you know, a 45% debt-to-income ratio.
Okay.
So that means, you know, we look at everything that you owe and that you have to pay in a month. Your car note, 45%. You know, there are places that will do loans if you're closer to 60%, 55, 60%. We want you to succeed in home ownership. So we want to make sure that this is a purchase that makes sense for you, that you can afford without, you know, skipping meals and doing crazy things like that.
On that note, we'll take a break. A final segment when we come back. And as I suspect, in cases like this, a lot of people just sit back and listen. But we've got the lines open. If you have a question specifically for yourself, wondering about getting one of these loans, but you're doing a great job answering all these questions. Want to get back, and we'll talk more about the website. And as I said, the number 737-7587. Back right after this.